The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
U.S. investors stay on the sidelines ahead of a big inflation report just 17 and a half hours away. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. You have a countdown clock. I like
do.
that. You were counting those moments.
I know. Not everyone. I can count too, Alex.
Yeah, he's so great when he counts. All right, well, let's not count the market here. Nothing is happening at a headline level. The S&P is on the lows, down by 0.1%, but it was a very calm session. You can see that reflected in the VIX as well as in the bond market. Even a 3-year auction that wasn't that great, but no one really seemed to care as we all really wait and see for tomorrow at 8:30. Romaine.
Absolutely. That is the big event here, and the run-up to the release of that government's monthly consumer price index report is pinning the S&P in what is now its tightest daily trading range since late March. A peak-to-trough move today of just 15 points. That's less than a third of the average daily price move this year. But don't expect tomorrow to be much stronger. According to Bank of America strategists, investors, they're pricing in the smallest implied reaction to a CPI release since 2021. That CPI report will, of course, be the final major economic release before the Fed's policy meeting next week. Any indication that the progress on curbing inflation has stalled, that could undercut chances of a third rate cut in a row, which could hold benchmark rates right where they are now, around 4.2%. And maybe that's why you're seeing so many corporations take advantage of the current yield situation while they can. Take a look at Monday. That was the second busiest day in history for U.S. leveraged loan launches. By Tuesday, blue chip companies had sold almost $1.5 trillion of bonds in the U.S. this year, a 26% jump from 2023. And mergers and acquisitions, they're in recovery mode. That includes rumors today of a take private for Walgreens Boots, which follows more than $40 billion worth of announced deals yesterday, a groundswell some see continuing into 2025.
In general, we're quite bullish, and we also concur that towards the middle to the back half, just based on how long it takes deals to kind of germinate, that it'll really pick up summertime and into year end.
And while some of this deal-making activity is obviously tied to an incoming Trump administration, a lot of it is tied to rates and the Fed.
Right, which leads us back to that all-important CPI number tomorrow. Now, in terms of the equity market, if you're an equity investor, maybe it won't be that big of a deal. Am I allowed to say that? So this shows the daily percentage move of the S&P 500 on each CPI release day, going all the way back to 2018. And the record gain for the S&P on CPI day was back in November of 2022 with a over 5% jump. But as we've seen over the last couple of releases, there hasn't been that much movement, maybe geared towards the upside, but nonetheless. And you can make an argument that you got PPI coming the next day. PPI feeds really well into PCE, and it's kind of where you might see sticky inflation, whether it's housing, whether it's car insurance, that will be the question mark. But to your point, Romaine, if it does mean anything for how many cuts we might see in 2025, that does feed back very much into the bond market, as well as you were pointing out, M&A and potentially corporate issuance.
Absolutely. As we kick you off to the close here on this Tuesday afternoon, let's bring Andrew Slimmon into the conversation. Senior Portfolio Manager and Head of Applied Equity Advisors with Morgan Stanley Investment Management. And let's start off with the inflation report, Andrew. I know short term to be sure, but obviously a lot of people think this could maybe set the backdrop for what we should expect out of the Fed in 2025. What do you think?
Well, I think, Alex talks about there hasn't been a big reaction. Maybe that's because the inflation numbers have come in pretty much in line, and the market did a good job of successfully anticipating that in advance. I think that has more to do with it than anything. But, as much as the market's not doing much today, there's a big undercurrent of change going on in the market. The winners year to date are really taking it on a chin relative to the losers. Momentum stocks have now sold off today and yesterday. And I can't help but wonder if that's the market's beginning to anticipate the Fed will adopt a more go slow attitude than they have in the past. That would cause some type of rotation out of what's worked year to date.
Well, I am curious about that because we had talked a little bit about a broadening of this rally over the last, 2, 3, even 4 months or so. Does that sort of get interrupted because of what the Fed does next, or is there going to be a little bit more life left in that trade?
Well, look, what's fascinating is in the last 5 years, the winners year to date have underperformed the losers year to date in December. It was only in 2022 that didn't happen. So, usually people wait around till next year to book gains, but the market gets in front of that and is starting to sell off. So I think, I think that's what's going on in the markets today, and the market needs a narrative to cause that. Maybe it is CPI comes in a little hotter than expected, and the Fed is not as dovish as previously thought.
Andrew, I was checking out S&P sectors and performance for the year. With the exception of the last 6 months, financials have outperformed. Other than that, it's consumer discretionary all day, anywhere you slice it. That to me doesn't say a rotation.
That's true, except financials have rocketed in the last 2 months, and big tech has actually lagged. Some of these Mag 7 stocks are actually underperforming the market overall year to date. So I hear you, but if you look at the quality tech stocks, they have really underperformed the speculative junk, lower quality growth. By that I mean companies that trade at monster earnings, very high beta, maybe they don't have any earnings at all. That's what's worked really since this fall is a much more speculative element to the markets until yesterday.
So if we're going to be taking tomorrow as sort of a benchmark for what we can expect next year from rate cuts, how would you be positioning? Would it be more risk on? Would it be more risk off? And what's the best way to express that?
Well, I think it's very hard to say I want more risk on after a year that looks like it's going to be close to 30% in a year like last year. Anyone who's more risk on, and I hear a lot of people coming on, talking about being more optimistic, and I scratch my head because they were more pessimistic in years past. It's hard to get more optimistic. I see too many there's just a lot of speculation in poor fundamentals. So that leads me to get a little bit more cautious or defensive on next year. I don't think this is a 2021 scenario where you had this huge bubble, in speculative stocks that burst and you had a bear market in 2022. But I think you have to think about what areas lagged this year, and maybe it's a little bit more defensiveness that works next year, like REITs. I think that's a very intriguing area that they're only up, the sector's only up about 9-10% for the year. Big underperformer. I think you have to start thinking about, more downside protection ideas, because the market has gone the other way. And we've gone from early in the bull market where people are very consumed and not losing money to later in bull markets where people are very focused on, where can I make a lot of money in speculative stocks? And that gets me a little bit more cautious.
And you've heard some folks, Andrew, that have talked about this idea of how do you protect the gains, these monster gains from 2024, 2023, et cetera. Is there sort of an income component? And I mean, I'm talking specifically being invested in equities, but is there an income component there, whether it's through dividend plays or even, buybacks to a certain extent, that does provide a little bit more safety, a little bit more protection if the market not necessarily sells off, but if it doesn't necessarily appreciate much further than where it is right now?
100% agree. In fact, dividend yielding stocks are some of the worst performing, components this year. And that gets me more interested. People don't want to own kind of the yield. They're looking for appreciation. The stocks. There's a ton of stocks that are up well over 100%. No, I would bet most of, a very high percentage of them have no dividend. So I think the return next year could come more in a balance between appreciation and yield. So I put higher weight on yield than I have, coming out of the bear market in 2022, which in my opinion was much more about buying upside opportunities. Now it's total return. As it pertains to corporate buyback, there is no question, Romaine, that following the companies that have the biggest buybacks, that's, as a strategy, that's worked. And I see no reason why that won't continue to work. So what does that mean? You're looking for companies to generate a lot of cash flow.
Yeah.
And whether that's buybacks or dividends, it's all the same. I think that's a very, very prudent strategy as I think out about next year.
All right, Andrew, always love talking to you. Andrew Slimmon, Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley Investment Management, kicking us off to the close here on this Tuesday afternoon. When we come back, a look at Arabica coffee futures surging to a record on this Tuesday afternoon as a major trader cutting its outlook for Brazil's coffee production.
All right, plus you got shares of Alaska Air soaring after reporting third quarter results, while the airline's newly unveiled global expansion plans have investors just jetting into the stock.
And playing ball in the business of sports, a deeper dive and a conversation with Dan Hunt, the owner of the Kansas City Chiefs and FC Dallas Soccer. All that and more coming up in just a bit, right here on The Close on Bloomberg.
Coffee hitting a record high today on mounting worries over a global supply crunch. This comes after one of the world's biggest coffee traders, Volcaf, cut its outlook for Brazil's Arabica production after a crop tour revealed just how serious the country's ongoing drought was impacting the world's top coffee grower. Here to discuss is Isis Almeida, Bloomberg Chicago Bureau Chief. Isis, it is so good to chat with you. First, let's just get the lay of the land here. There's two different types of coffee, Robusta and Arabica. Walk us through the fundamentals of both of those right now.
Thank you for having me. Yes, Arabica coffee, it's like the premium stuff that you see usually favored by Starbucks, and Robusta coffee is simple as usually a lot of the stuff that you see in instant coffee and your Nescafe every day. And I think that both markets have seen really tight supplies, have seen prices go up a lot, but I think the biggest surprise has been this this really new outlook that Volcaf slashed their outlook for Brazil Arabica, and I think that came as a surprise to a lot of the market. It rained a lot in Brazil in October, and some of the market had thought that the worst was behind us, but apparently not.
I am curious, though, when we talk about the tightness that we're seeing in this market, is this all about the constraints to supply because of the weather, or is this also about an increase in demand by new coffee drinkers or coffee drinkers drinking more?
Yeah, I think a lot of it is actually supply driven, and it's funny that you talk about that because if you think about what's happened in cocoa markets this year, we've seen cocoa prices hit $10,000, and I think now we're seeing coffee at $3.50, which is unprecedented. We finally took the 1977 high in coffee, and it's really being supply driven. I think one of the things that's happened is productions of both commodities have accumulated in two countries, in the case of coffee in Brazil and Vietnam, and therefore any supply shocks, any weather changes really hits the market in a much harder way than in markets where supply is more diversified. So yeah, it's really a supply driven market right now.
I guess the question, though, is how long does that last? Like in Brazil, we've seen sort of 4-year struggle when it comes to coffee output. Is that the same, though, when it comes to cocoa, for example, in terms of the long-term effects?
Yeah, I mean, with cocoa, we've seen the production in Ivory Coast and Ghana drop significantly, and the market doesn't think that we're going to recover until at least 2026. I think one of the things that you see with crops like cocoa and coffee is that they don't get planted every year like corn and soybeans. They are tree crops, so these trees take longer to recover, and sometimes what happens in 1 year spills over into the next years. I always give the 77 price rally as a good example of coffee. Like in coffee, Brazil had a major frost, which was called the Black Frost, and that happened in 75, but actually the high of the prices were only hit in 77 because the effect of that on the tree itself lasted for a couple of years, and therefore tree crops are so much more susceptible to these long price issues.
I am curious, just real quickly, Isis, on the difference between Arabica and Robusta. I always thought that whenever we would see prices spike, particularly on Arabica, usually the default would be at least certain producers could rotate into Robusta. But we've also seen, obviously, elevated pricing there as well. Are these grown in the same countries, in the same regions, so they're basically affected by the same weather patterns?
Yeah, a lot of them are grown in the same countries. Brazil and Vietnam is where the concentration is for both Arabica and Robusta. Obviously, Arabica is grown in higher elevations, so it's different parts of the country, but truly the concentration of supplies in both Arabica and Robusta in just two countries is something that's happened. And this time around, it's a little bit harder for roasters to go and switch to Robusta because the Robusta prices actually rallied before Arabica.
All right, Isis. Well, we're all keeping an eye on this. Of course, keeping an eye as well on our bank accounts as we, of course, now have to shell out a lot more for coffee and cocoa.
You don't drink coffee.
Isis, Almeida, I drink cocoa, hot cocoa this time of year. Come on.
Literally, coffee and cocoa, like my two food groups. Like, I don't know what I'm going to do.
Groups.
Like, it's all over for me.
I mean, the prices are astonishing. You talk about an 80% run up in Arabica prices. Robusta not much far behind it. And as she pointed that out, too, I mean, 1972. That was the last time. I mean, you had to go all the way. I mean, that's as far as the records go back. So maybe this is even worse than that. That's a lifetime, Alex Steele.
Yes, it is a lifetime. It's like your lifetime.
I know. I was born in
Don't say it.
2005.
Oh, 2005.
All right, coming up here, we're going to talk about commercial real estate and improvements in Manhattan's commercial real estate market. Get ready for it. It's paying off, apparently, for SL Green, one of the biggest commercial property landlords here in New York City. That's coming up next in our top calls as we talk to an analyst who's ditching his sell rating on the stock. This is The Close on Bloomberg. All right, let's get a view from the sell side. Our top calls, the big movers on the back of analyst recommendations. And we're going to start off today with Pinterest. Analysts over at Piper Sandler moving to the sidelines with the neutral rating and a $36 target after 2 quarters of mixed prints. Revenue growth at the social media company isn't measuring up to expectations, the analyst says, as advertisers shift strategies and opt to utilize other platforms like TikTok. Those shares down 4% on the day. Next in line, American Airlines raised to outperform over at Bernstein with the analyst David Vernon saying American's exclusive co-branded credit card deal with Citi enhances the airline's financial outlook. He also sees improvements in pricing and fuel costs driving a better fourth quarter outlook. Those shares up 1.5%. And finally, Norwegian Cruise Lines, a lift to buy from neutral over at Goldman Sachs. The analyst Lizzie Dove expecting a solid year ahead for leisure and another stellar year for cruises. She highlights data that points to growing consumer intent to book cruises, as well as significant cost savings still to be realized in the stock's valuation. The stock's valuation going up by roughly 2.3%. And those are some of our top calls on the day. As we turn our attention now to commercial real estate, specifically the office real estate market here in New York City. Real estate investment firm SL Green able to shake off a sell equivalent rating over at JPMorgan, with the analysts upgrading to neutral on the belief that the New York City office fundamentals are improving at a solid pace. Anthony Paolone is joining us right now, senior analyst and co-head of U.S. real estate stock research at JPMorgan. Commercial real estate, particularly in New York, Anthony, as you know, was kind of left for dead 2, 3, 4 years ago here. It's bounced back, and it's bounced back significantly. That's enough to keep SL Green in the black?
We think it is. So first of all, thanks for having me on. And SL Green had their investor day yesterday, and there was one stat they mentioned that I think was very important to think about, which was if you're a tenant out there in New York City looking for 250,000 square feet or more in Midtown, you've got 6 options. And so this is really the largest office market in the country, and for a larger tenant to have so few options gives you a sense that that demand has come back. It's absorbing some of the best space in the market, and that makes the outlook here a bit better than it was not too long ago.
So we're talking about a potential rebound story for New York City, a potential rebound story for the office market, and obviously now one for SL Green, which I think is up more than 60% year to date. How much is left here in this stock, Anthony, given how far it's come over the past year?
Well, it's a good question, and there could be a lot more if we see continued demand from the large users, and we see that demand really broaden out through the city over the next couple of years. There could be a lot more. I think the offset that we're going to have to watch, and this is why we moved to neutral and we haven't gone fully to an overweight here, is that there's going to be a cost associated with getting the occupancy that was lost to come back, and there's a lot of upfront costs in the form of CapEx and leasing commissions, the downtime, and that's going to put some pressure on cash flows in the near term. But if you start to see the demand really push through that, and we start to see really multiple years of growth here, then there could be a lot more upside.
What would be a trigger, Anthony, do you think that would make you even more positive on the stock? Does it have to do with the macro and rates, or is it an execution for SL Green?
Well, I think macro does play a big role on real estate generally, but I think for SL Green more specifically, one thing that could be interesting is to the extent they are successful going out and playing offense again. This was a big theme at their investor day yesterday, and the company's in a situation where it has access to capital at a reasonably attractive cost. And so if you start to see transaction activity come back over the next couple of years, we haven't seen a lot of big trades in New York City in a while, you start to see a lot of that coming back, and they have the ability to participate in that. That could be a real catalyst to the upside because they should be able to do so accretively to their growth.
They also recently raised money from a Canadian pension fund. They're targeting about $1 billion in total for a recent fund. Like, where do you think they need to deploy that, and how frequently? Like, what's the sweet spot for them with that money?
Well, they did raise a fund, and for that specific fund, it's to be opportunistic around debt and taking advantage of purchasing mortgages and other pieces of debt where they can generate good returns right now. But if you look across all of the company's capabilities, that's not the limitation there. There's a lot more places they could go. They talked about office to residential conversions. They're active in street retail, traditional office acquisitions, and even ground-up development was a theme.
Hey, Anthony, we're going to have to leave it there. Really appreciate you joining us. Anthony Paolone over at JPMorgan, a closer look at the real estate market, and now a closer look at M&A, a redhead crossing the Bloomberg terminal involving Albertsons and Kroger, the two big grocery chains in the U.S. that have been seeking to combine. We're now learning that that deal has been blocked by federal regulators. The FTC and U.S. states had sued to stop what had been roughly a $25 billion deal, a deal that we know had been in jeopardy for months. And we're now learning that that deal has been blocked by federal regulator, by a federal judge, excuse me.
Yeah, looking at Kroger stock, that stock up about 4%. But you wonder, does this hold under a Trump presidency, or how does this then evolve? This has been like years.
Yeah, we're like 2 years into this almost now. And I guess the big question is, I guess if Kroger wants to go back and try to appeal and maybe buy some time until January 20th, just about a month or so away, maybe he'll have a different regulatory climate. But again, when you think about how much time they've put into this, how much money, and I don't know what the breakup fee is as well, maybe they're in a position where they just say, you know what, let's just move on.
No, it's such a good point in terms of the breakup fee. And just even a few months ago, they priced almost $10 billion of notes to fund the deal. So how that winds up turning out as well.
We should point out Albertsons shares are halted. They had dropped about 5% before the halt. Kroger shares up about 5%. And this actually sets us up nice for our next guest.
It does. Good segue, a conversation with Ted Smith, co-founder of Union Square Advisors, his take on the M&A market in 2025. This is The Close on Bloomberg.
The $14 billion bid for U.S. steel by Japanese firm Nippon Steel is now going to be blocked by the Biden administration. According to people familiar with the situation that Bloomberg reporters have spoken to, President Joe Biden plans to formally block that deal on national security grounds once that deal is referred back to him later this month by CFIUS. Of course, this deal has been under review for several weeks now. A lot of opposition, not only by the Biden administration, but to a certain extent by the incoming Trump administration. And we're now learning that President Joe Biden, who only has a little more than a month left in his term as president, plans to formally block this deal. Alex.
And speaking of, also Kroger as well has his acquisition of Albertson has been blocked by a federal judge. If we remember, the FTC also blocked the acquisition. This has been a deal 2 years in the making. It's a $24.6 billion deal. Kroger in its last earnings call was pretty positive about the deal going through and reiterated its confidence. But now it looks like the FTC and states have successfully sued to stop the merger of Kroger and Albertson. I feel like it's M&A tank day today.
Yeah, and it's kind of weird because it's against the backdrop of a huge upswell that we've seen in M&A. You had $40 billion of deals were announced on Monday. But you take a look at those two names there, and here's a question for you. If those deals had been proposed, say, in a month and a half, do you think they would have had a better chance of getting through?
Well, that's a great question because you have to wonder, do you want to get into the long line and wait your turn, even though it might get killed, but then you're up near the queue in a new administration, or do you just need to wait until January 21st?
Yeah, and look, I mean, you look at the amount of deals announced, and it's not just M&A specifically. You talk about new issuance, particularly in the high yield space. You had, one Monday ago, a week ago, you had the biggest day for leveraged loan issuance in history here in the U.S. That's not by accident.
Well, just look at the headline that the Wall Street Journal broke today about Sycamore maybe taking Walgreens private as well.
Yeah.
And all of those kind of deals percolating. And how do you think they're going to pay for that? So then that's going to increase debt issuance as well. Let's take on all of this with Ted Smith, partner, co-founder, and president at Union Square Advisors. Ted, yesterday was M&A Monday, and today it feels like, hold on, M&A Tuesday, like maybe not so fast. What do you think is happening here right now?
Well, I think the Toast Tuesday aspect of this, national security concerns, right? Really large transactions that have significant effect on consumers, as in the Kroger-Albertsons deals. Those are the sorts of things that you would expect to continue to get scrutiny. Old administration, new administration, in our opinion. Whereas more broadly, the gear up that has been happening really since the election landed has been significant, both in terms of the deals that we started to see get announced, as well as just the activity level that we're seeing in people who are preparing to start to go in Q1.
So is it an idea that the mergers were kind of ready to go and now we're just going to sort of go with it because we know who's going to be in the White House? Or now you have companies being like, cool, let me take a look now at my landscape and see who I want to buy?
I think there's some of both of that.
Okay.
And I also think the fact that we are seeing, again, we're seeing the interest rates coming down a little bit. We're seeing activity from strategics, at least in the U.S., who continue to feel good about their businesses from an economic perspective. Obviously, we've sort of defied gravity in the States relative to Europe and other parts of the world with respect to not sliding into a recession. So strategics are excited to now lean back into strategic transactions because they feel like there's more likelihood they can do something. And we've talked before, the three of us, about there's so much capital out there in private equity land that has to find a home. Mm-hmm. And eventually that dam has to break. And it feels like 2025 is going to be that year.
Well, that's what I'm curious about. If you just took a sheet of some of the biggest private companies out there, I mean, you salivate. I mean, if you're an investor, you're salivating to see these names come to the public market.
Right.
And there's a reason why they haven't. And you think that 2025, because of the regulatory environment, the rate environment, the economic environment, that's going to open the door? What?
I think, let's go in reverse order.
Okay.
The regulatory environment, or I guess I'm going the right order, that's an unknown still.
Okay,
I don't think we know, and particularly in tech, because we have an incoming administration that has been, at times, not indifferent to tech, but unclear on what its stance is going to be on various aspects of tech. Mm-hmm. I think it will be more positive than what we've seen for the last 4 years, but I don't think it's just sort of opened the floodgates exclusively for the largest tech buyers, right? The Magnificent Seven, if you will. Beneath that radar, I think you're going to see a lot of tech transactions. Wow. Then on top of that, improving economic environment generally, improving interest rate environment, those are obviously both positives. That will fuel additional M&A activity.
I'm going to ask you a very loaded question. Are these going to be good deals? And by that, I mean, sometimes when you see this type of euphoria, you get a lot of good money chasing after bad, so to speak. And I wonder if we're going to see a repeat of that. Or do you have this sense here that you and your peers are maybe a little bit more scrutinous, a little bit more level-headed, heading into what could be a boom year for you?
I think buyers are more measured. I think the valuation disconnect that we've seen, really, at least in tech land, from 2021 through 2023 has largely come into alignment. Doesn't mean it's perfect, but people are willing to be aggressive, but they're not willing to be crazy in many cases. So I think we're going to see better deals going forward.
When we take a look at tech, where specifically? Like if we're going to take away the big guys for a second, where within the tier B or smaller players?
Well, I think everything, the Mark Andreessen.
Anything that says AI?
Anything that says AI is going to continue to be popular. We've just started to scratch the surface about how AI can help companies reduce costs, drive greater productivity, enhance revenues and earnings. So we're still there. Now, that doesn't mean every AI company is going to be successful, but it does mean that we're going to see continued significant investment there and ultimately exits. More broadly, we love the intersection of the healthcare and technology sectors. We've obviously got a very complicated healthcare system in this country and around the world. We have AI mattering more and more to that sector, but also just generally software that helps pharma companies, med device companies, payers, providers be more efficient and ultimately deliver a better patient experience. That's also we're just at the beginning stages of that.
Does OpenAI go public next year?
I don't think so, personally. I think they can. The question is, do you want to? They've obviously got a whole bunch of things they've got to get right before they want to be a public company. They'll have the scale to be able to do so, but I don't think they'll have the desire just yet.
Outside of AI and I guess sort of that bigger big tech space here. Are there any areas that you're looking at right now where you do think we are going to see a tremendous amount of activity sectors-wise?
Well, I mentioned health tech. We're seeing a lot of activity in the GRC space, governance, risk, and compliance. So technologies that help both governments as well as large organizations manage their risks, right? It's a risky world out there, right? And so software that helps companies manage external threats, manage internal threats. A lot of great, really interesting private companies that we think could be big M&A targets. Eventually, some of those may go public as well, but GRC is another really hot space.
I didn't ask you about cross-border transactions. I mean, we talk about the Nippon Steel deal. Obviously, that was contentious for a lot of reasons, primarily because you had a Japanese company trying to buy a U.S. company, kind of the last standing U.S. company, at least in the steel space. I assume those deals, even under a Trump administration, probably don't have a huge chance of getting done.
I think, the ones that have national security implications, I think pretty tough. I think Chinese buyers for U.S.-based assets, pretty tough. I think if you've got, Western companies in Europe coming over to buy U.S.-based companies, more likelihood that some of those can get done. To me, the more interesting aspect, or at least equally interesting aspect, is we've seen an incredible amount of activity out of the European regulators watching deals, not just the U.S. regulators, European regulators stepping in to push back on some deals, and I think that's going to continue.
What about the deals that have been killed, and maybe not just Kroger, but also some of the airline deals like a JetBlue Spirit, American, and JetBlue? What happens to them? Do you think we see a resurgence of deals that have been pushed to the side in the last 4 years? Do they come back?
I think some of them will take another run at it, right? Again, new day, new administration, new view on some of this. So I think we will see some of those.
All right, Ted, always great to talk to you. Ted Smith, partner, co-founder, and president at Union Square Advisors. And just to reiterate that breaking news he had a little while ago, that U.S. Steel, Nippon Steel deal are going to be formally blocked by the Biden administration, and that deal between Albertsons and Kroger now officially scuttled by a federal judge. Shares of U.S. Steel halted at the moment, as are shares of Albertsons. We want to pivot from that to, shares that aren't halted. Alaska Airlines, those shares are all over the place after the carrier boosted its fourth quarter adjusted EPS forecast and unveiled plans for a global expansion, a 13% jump in the stock today. Sheila Kahyaoglu joining us right now, managing director and equity research analyst at Jefferies, covering aerospace and defense. Are you surprised by this?
In general, we've seen positive momentum in airlines, up 60% since the end of the quarter. And we're starting to see the EPS revisions. The bear argument was we really haven't seen those. And, Delta reaffirmed their guidance 2-3 weeks ago. And now you've seen JetBlue, Southwest, American with positive announcements, in Alaska, of course, today.
I am curious, too, when we talk about, and specifically with Alaska, you talk about the tie-up with Hawaiian, and there was a lot of discussion here about how a regional carrier survives in what has basically become kind of this conglomerate space here. Is there sort of a space for in Alaska for those sort of regional carriers?
Certainly so. I think the shift has been to network carriers. The bigger, the better. Higher international revenues are certainly helpful for Delta and United, leading the way on margins in the mid-teens to high teens. Alaska is just hitting double digits, but I think airlines are trying to prove that they're sustainable consumer models, that they could grow low single digits, have rational capacity. You've seen low-cost carriers take out capacity out of the market. That was what was up 6 to 7% in the first half, driving prices down for tickets domestically and ruining it for everybody, essentially. So what airlines want to say is they could grow low single-digit capacity, have pricing premiums because of their international exposure, because of premium, grow earnings in line with that, and have other offerings like MRO shops, whether that's Delta Tech Ops or credit card deals, which is what we're seeing a lot of popularity with.
Right, which is what got an upgrade for American with this credit card deal with Citi. So we just asked this question to Ted, which was, are we going to see the comeback of deals that were already killed, like a JetBlue and Spirit, for example? Like, do you think we're going to see some of those deals come back under a Trump administration, or do you think that they've trimmed enough capacity, got their ducks in a row, that they can go on their own?
I think broader coverage, including aerospace and defense, what we've seen is a lot of regulation within the Biden administration block transactions. And so you could see that open up. I don't necessarily think JetBlue and Spirit make sense. Two low-cost carriers necessarily need to exist. So you could see that capacity come out of the market, probably beneficial for everyone involved. But in general, I think you could see more transactions across the space. Not that we've seen anything blocked in aerospace and defense, but we've seen deadlines hit the very last day. So it can make it more lucrative to do deals for a name like a TransDigm, a HEICO, less deregulation, pushes more deals happening in the sector.
Let's talk about profit margins too. So Willie Walsh over at IATA was saying today that he sees better profit margins for next year because of that capacity issue. Also, you have lower gas prices, fuel prices, which would really help. Do you think we're going to see that momentum really pick up, and when?
I think you're starting to see that with these Q4 upgrades and into 25. And I think that's what Delta's day 3 weeks ago really tried to set the theme for. Like, listen, we could have double-digit sustainable EBITDA margins because we have a premium offering, because we have all of our costs set up outside of fuel, right? They've all went into labor contracts over the last few years. So I think we've seen a more rational environment. I don't know if IATA's forecast has necessarily been right over the last few years, but I think we're trying to pick the winners within the space, which is highest premium offering and highest Atlantic exposure, which I would say United is one to watch as well. That stock is up over 100% this year, but the transatlantic exposure, they're talking about being up 30% above 2019 levels, up 10% year on year. They're not ones that raise guidance intra-quarter, so we'll have to wait till Q4 results for that one, but it's been a spectacular performer on their regional allocation of assets.
I am curious, too, how some of these airlines are evolving, particularly you talk about JetBlue and kind of that move for Spirit, which I think caught a lot of people off guard, but also Southwest Airlines, which seems to be going through some weird growing pains here. And I know there's some optimism when it comes to what we should expect out of the earnings going forward here, but I'm not sure what to make of it. Its identity, it had a very clear identity for years, and it seems to be pushing against that for obvious reasons. But I'm curious as to whether you think that it's a positive thing as to what they're doing.
So we upgraded Southwest recently from a underperform rating to a hold rating. And that's about as far as I'll go, because I do think you're seeing one-time improvements in their business model. They're doing sale leasebacks, so essentially leasing out aircraft that they have for $5 million profit. And of course, that's going to drive a rate of change that's not necessarily sustainable longer term. But I think Southwest's struggle is it's where it is structurally in the U.S. That flight from Columbus, Ohio to Chicago post-pandemic might not need to happen every Monday morning anymore as people work from home, trying to sort of have a different structural change. And I think Southwest recognized that with its Analyst Day and decided to implement some changes a few months ago. They're including red-eye flights just because that capacity was dead anyway, so why not actually have the aircraft fly? They're changing their seating structure, which I don't think is their extra legroom is truly warranting a 30% premium.
It's not.
But at least they're doing something about it. I don't think they're going to be able to retrofit all 700 planes in 1 year, but kudos to them for making the changes and being active, because you don't always see that with a management team. Obviously, they had an activist involved with about a 10% stake. So
we have to ask you about Boeing and the progress that they're making. It was kind of interesting to hear the Alaska Air CEO actually kind of commend the new leadership for some of the changes they made in the short few months that they've been there here. Where do you see Boeing going right now?
So it's all been about original equipment plays in my sector. Everybody's looking for that rate of change that's accelerating. And of course, Kelly Ortberg's been on the job maybe 130 days. He's had a 10% headcount reduction, a strike, 25 billion equity raise or so. Lots of things going on that he can't even focus on the core business. But post the strike, obviously zero deliveries in October, a big rate of change in November that we just saw this morning, and then a step up in December. So everybody's wants to see those deliveries. Recall, we had 700 aircraft that we thought Boeing would deliver this year. We're at 380 or 350 for this year, so we've had a massive reduction. So now everybody's hoping we could, 1 year post-Alaska, essentially, we could get back on track with deliveries, and that should be helpful for aircraft deliveries to grow, hence pulling back on the aftermarket names that have been superb performers this year.
Waiting for it. We're waiting for it. All right, Sheila, thanks a lot. Really appreciate it. Sheila Kahyaoglu, Managing Director and Equity Research Analyst over at Jefferies. And just to point out here, some of the airline stocks hitting 52-week highs, like American Air, like Alaska Air, 52-week highs now for those companies.
Absolutely. And we know travel's been solid. I mean, look, if these companies want to make money, the money is to be had. I don't know if you've booked a flight lately, but they're still expensive.
I have not.
Yeah.
Well, but I'm a Delta person, so there's no deals that I can find in Delta, but the smaller guys maybe.
And Black Friday, I was looking around for Black Friday travel deals.
Really?
Yeah,
and
it was kind of a pittance. Yeah.
It was 5% off on your JetBlue vacation.
Yeah, to Cincinnati.
Yeah, all right. George Patterson joining us next to walk us to the close.
As much as the market's not doing much today, there's a big undercurrent of change going on in the market. The winners year to date are really taking it on a chin. relative to the losers. Momentum stocks have now sold off today and yesterday.
Andrew Slimmon over at Morgan Stanley Investment Management, kicking us off to the close just about 50 minutes ago. This has been a bit of a momentum-driven market. I know the price action today not really reflective of that, but you look at the price action over the last few weeks, Alex, and that's effectively what it's been.
Yeah, price action, though, to the downside. Little momentum there. We're picking up some steam as we close, down 0.3%. I wanted to point out remain some winners and losers, because obviously the airline's doing really well. American Air, Alaska, 52-week highs. But you know the SOX index, the semis, getting hit really hard. You got Broadcom, you have Advanced Micro Devices, NVIDIA, all really dragging the NASDAQ 100 down.
And one thing I tell all our viewers to do is go look at the biggest gainers through the first 6-7 months of this year.
Yep.
And then look at what's led this market over the last 4.5-5 months here. You'll see a big turnaround. The SOX ain't at the top of that list anymore.
Yep, no, it's not. It's fairly interesting. And you have financials doing pretty well for that.
Yeah, look at that. You see NVIDIA, Micron, Broadcom, and AMD all down significantly here on the day. As we move closer to these closing bells with just about 8.5 minutes to go, we want to welcome on to the program George Patterson, Chief Investment Officer at PGIM Quantitative Solutions. George, great to see you here.
Always great to be here.
Let's first talk about momentum and how much momentum is left in this rally. What do you see?
Momentum is a very challenging factor. It's one of these factors that tends to work well for a long time, and then you can get all of a sudden a tail event, large price reversal. So it's something that you have to be very careful about, looking purely at price momentum. So hard to say if it's fully over, but it's something you have to be very cautious about trading the downside.
When folks are looking at chasing after the gains in this market, I mean, we're sitting on a phenomenal year by any measure. Heading into 2025, there are a lot of people saying this can't repeat itself. Let's just take the S&P as the proxy, that can't repeat itself. History says it shouldn't. Is there any evidence to say that maybe it can?
So when we look long term, yes, the U.S. is pricey, and that is a headwind. However, the economy is doing well, and stocks are basically a proxy for the overall GDP. So if we think the economy is going to continue to do well, and we've seen lots of evidence of that, consumers, healthy job market, inflation coming under control, I think we could still see a strong economy, and I think we could still see some gains in the stock market. Over the longer term, you think out 10 years, yes, there could be some challenges. But it could also be that the earnings grow into the valuations.
So how do you express that view? Is it going to be just continue the growth momentum trade or what?
So for us, we focus a little bit less on straight price momentum. And there has to be several. Price momentum may be one thing that we look at, but usually there has to be several elements of that. Typically, when we think about an asset allocation perspective, we are overweight risk assets, overweight U.S. equities, a slight, maybe some appetite for certain emerging market segments, but definitely U.S. large cap and U.S. small cap.
Oh, okay, U.S. small cap. So small and large? Well, what about mid? Because I feel like mid, for example, in some ways was the sweet spot for like 6 weeks.
Yeah, mid is also, I think of it just anything beyond like the mega magnificent seven or however you measure the top of the market. That's really what's driven the S&P 500 to be so expensive. When you look below that, there's still a lot of attractive opportunities.
When we talk about all those opportunities and why those stocks, for one reason, were left behind, what's changed that gives people the confidence that we are going to see a rebound in those names?
So there's several things. First of all, when you're at the top of the market and you're growing at that pace, it's just very hard to grow without all of us becoming employees of those companies. Like trees don't grow to the moon or trees don't grow to the sky. And at some point you just can't continue to be, you're going to grow into the whole economy if you continue those numbers. The other thing is that we're seeing earnings broaden, right? So earnings is now not just earnings growth is not just happening in the top names, it's actually seeing it in the mid cap and in the small cap in the future. The other thing, too, is that all the research indicates that a unified government is going to be much friendlier to capturing a small cap premium. So this is going to be the time we think that small caps are going to get rewarded over this next few years.
How much deal activity could we see that could sort of drive the price action to the upside?
I think we're going to see an administration that's going to be much more friendly towards deals and transactions. I think, to be honest, a lot of bankers, and they're probably a better source than I am, are going to be very excited about the prospect of being able to kind of do some of these deals and get them over the finish line.
Mm-hmm. Oh, they definitely will be, I'm sure.
Bankers and lawyers, great.
Yeah,
lawyers.
Definitely the lawyers. Can we talk about sectors for a second? Like, what sectors do you think fit the bill for you guys to take on a little bit more risk?
So we typically don't focus on specific sectors. We tend to be much more broadly based. Mm-hmm. So, timing one sector versus another is typically not something we're as active in doing. We're looking for solid fundamentals. We're looking for solid fundamentals, reasonable growth opportunities, and wherever that may be. We are a quantitative manager. We have a systematic process. Our process really is built on fundamentals, but we implement it in a systematic manner. So we find good opportunities in every sector. Rarely do we want to take a big bet on one particular sector.
When we talk about policy for a second, too, there's going to be like two upsides, two downsides for policy, right? You have immigration and tariffs on the one hand, and then you have fiscal and taxes and deregulation on the other, right? How do you guys think of the sequencing of that? Because in some ways, the sequencing, it will then determine how it affects the market.
Yeah, this is something we're very much in a wait-and-see mode. Mm-hmm. We need to see, I think some of the picks for the administration are not finalized. I think many of these issues are also very subtle. Immigration is double-edged sword. Yes, there are probably parts of immigration where it doesn't make sense to have as many people, yet there's other areas where, for example, we bring in people from other countries, send them to graduate school, have them get a PhD in some advanced technology, and then send them back because they don't have a visa. So none of these issues are simple. There's usually two sides to everything, and it's really figuring out how do you isolate what you want versus not wanting. That's really where I think someone has some statecraft ahead of them.
Go ahead.
I'm sorry, we only have about 30 seconds left, but I just want to know what your big risk that you're looking at for 2025. What's that big thing that you keep an eye on?
I think the one thing we do worry about is inflation reaccelerating. To the extent that there are tariffs can be very useful. They can be targeted. When there are substitutes, less likely to bleed over. When you start getting very broad-based tariffs, that could cause inflation to accelerate. And once you get up above like the 3-4% range, then it starts getting to be harmful. At that point, it becomes much more of a distraction. That's really the main concern. Yeah. From a policy perspective.
All right, George, always appreciate talking to you. Great insights as always. George Patterson, Chief Investment Officer at PGIM Quantitative Solutions. Just about 2.5 minutes until the closing bells. Stocks at session lows.
Session lows. And to your point, in terms of the Fed and then hiking rate, or not hiking, but less cutting, Thorsten Slott's been saying that. Like, we have to talk about the fact that inflation could come up. Maybe we won't have those cuts in 2025.
Yeah, the Fed meeting, that 2-day Fed meeting starts 1 week from today. A full breakdown of all of today's action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through that closing bell, a global simulcast. It starts right now. Scarlet Fu being wheeled into the TV studio. Carol Masser, look at that. Back in the radio booth alongside Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms.
It's the wheel
Here
day.
On this Tuesday, you had a nice long, 12-day weekend, Carol. Great to have you back.
Thank you.
Big stories out there today, all involving M&A. Kroger's deal potentially being blocked. Well,
I know. I don't know.
Walgreens Boots maybe going take private. I wasn't done. You got to wait for the dramatic pause, Carol Masser.
Do I have it yet?
No.
Okay.
And Nippon Steel,
I know.
U.S. Steel, looks like that's done.
Look at U.S. Steel. Although Joe Doe was just in the studio and he's like, may not be completely done. So we're going to watch for that one. I will just say I've been watching the home builders, man. They're under pressure, down about 3% here. And this has to do with Toll coming out, Toll Brothers. And they gave out a forecast indicating continued pricing pressure due to high mortgage rates. So we've seen the whole home builder group under pressure in today's session.
How come everyone's ignoring Bitcoin? Down 0.6%, above $95,000.
0.6%?
Yeah,
that's why we're all ignoring
it. Is that allowed for Bitcoin? I thought they were only supposed to move in like increments of 10% or more.
Bitcoin's price.
Yeah.
Do not worry.
All right, thank you.
Yeah, hit $100,000, then comes back.
Yeah,
exactly. That's basically unchanged for Bitcoin at this point. You got to wonder though about these deals that are blocked. I mean, won't the companies just kind of sit tight for a couple months and then they can push it through again?
Well, that was my question, Scarlett. I mean, obviously the Kroger deal, which has been like 2 years in the making, I guess I could understand why they would walk away from that. But you also kind of wonder, I don't know, if you had waited another month and a half, would you have a different environment?
I mean, it's very possible, but it's been 2 years already. So
yeah, I guess, yeah. And as a Bloomberg reporters are pointing out, they've already racked up almost $1 billion in costs related to that acquisition. And that's not even including a potential breakup fee should it fall apart. We get the closing bells in New York, and it is red across the screen here in U.S. markets. The Dow Jones Industrial Average down 150 points, or about 0.3%. Similar percentage drops for the S&P 500 as well as the NASDAQ Composite. The Russell 2000 closing out the day down about 10 points, or 0.4%.
All right, back to the big caps I go in the S&P 500, guys, and it's definitely a much more negative tone today. 154 names in the S&P 500 gaining ground today. Scarlett, 348 to the downside.
All right, let's take a look at the sector performances too, because there's a lot of red on that screen. You've got communications, services, consumer staples, and consumer discretionary in the green, but really the only group that is up firmly is communications services, thanks to Alphabet. On the downside, tech and REITs losing at least 1%, and materials and utilities also down about 0.8 and 0.9%.
All right, let's get to some of the individual gainers, if I may. And Walgreens Boots, this is your number one gainer in the S&P 500. It's up almost 18% in today's session. Wall Street Journal coming out with a report earlier today that the company's in talks to sell itself to Sycamore Partners. It's a PE private equity firm. So we saw really big moves. Stock was up as much as 28% in today's session. Its biggest single day gain since at least 1980. That was on, of course, an intraday basis. So keep in mind that this is a stock that's been under pressure throughout the last year, losing about 2/3 of their value over the course of the year through Monday. So interesting to see, and we'll have to see ultimately whether or not some kind of deal gets done.
Yeah, the Journal had some great statistics showing all the sort of takeover attempts or takeover sort of kicking the tires of this company and the valuations they were at, and it's just down.
Yeah, right. Yeah. So a little bit of a different tone today, but we'll see what happens. So stand by, TBD on this one. Google, Alphabet, this one was top gainers in both the NASDAQ 100 and the S&P 500, guys, up almost 6% in today's session. You had the company analysts applauding the Google parent announcement yesterday of a major development in quantum computing through the use of its Willow quantum chip. So there's some of that going on. There's another side story on how Google is investing in mega energy parks that will generate renewable power as the company races to fuel its data centers. I mean, that's been going on as an aside. But anyway, that one definitely on our radar. And then I just want to bring up Boeing, if I may, in terms of that company. And that stock, I'm looking at about a 4.5% gain in today's session, so a little bit off its highs, saying it resumed assembly of its best-selling aircraft after a debilitating 53-day-long strike. November deliveries coming in at the lowest in 4 years. So they're delivering 737 MAX models in November, some 787 Dreamliners, and 2 777 freighters as well. I just came in from South Carolina, and they have a Boeing facility.
I knew you were going to do that, Roman.
Anyway, they have a Boeing facility, and I saw a lot of planes looked like they were ready to go.
That's where they do 787s.
Yeah,
down there.
yeah, definitely saw that.
Hey, I want to start with Oracle shares. In the S&P 500, it was among the worst performers on a percentage basis. They fell the most in a year after the company reported lukewarm quarterly revenue. It disappointed investors who had sent shares of the company to its best year-to-date performance going back a couple decades. The company did recently boost the stock to a record high on enthusiasm for that cloud business. As we mentioned just minutes ago, a lot of news moving stocks late in the trading session having to do with M&A, starting with Albertsons. Shares fell as much as 10% after a judge blocked Kroger's $24.6 billion acquisition of Albertsons. But look at that, just in the final minutes of trading, giving back some of those losses, bouncing up, shares closing down about 2.3%. The judge is finding that the takeover would lessen competition for U.S. grocery shoppers. A ruling marks a likely death knell for the deal. We did have Jennifer Rhee, Bloomberg Intelligence Senior Antitrust Litigation Analyst, on the program. She was a bit surprised by that initial stock reaction, given that a lot of folks were skeptical this deal would actually go through. And Jen, by the way, saying she thinks this one is done, and these two are living on as sort of standalone companies, at least in the near future. And then finally, shares of U.S. Steel, ticker X, down 9.7% today. President Joe Biden planning to formally block the $14.1 billion sale of U.S. Steel Corp to Nippon Steel on national security grounds once that deal is referred back to him later this month. This, according to people familiar with the matter. Joe Doe and Josh Wingrove on our Bloomberg News team having the exclusive on this one.
All right, well, I'm taking a look at the bond market, guys, because it wasn't that exciting either. You saw a little bit of selling pretty much across the curve. You had a 3-year auction that was a little bit light, but like nothing to write home about. And I do want to point out tomorrow you get the 10-year and then you get the 30-year, which will be about, quick math in my head, $63 billion worth over the next 2 days. So we'll see how that goes. So look at the long end for that one.
Well
did you really
done,
do that
well
in your head?
done.
I did. Was I right? 40, 50, 60? Yeah.
I'm
No,
sure
61. 61.
I don't know if you say so.
I could have done that before. But okay, 61 billion.
The government needs to raise a lot of money.
Yeah.
All right, guys, we are still getting some earnings, including not a Stitch Fix here. 1Q operating loss of from continuing operations of about 5 cents a share. Not quite clear the comparison on that here, but their revenue in the quarter also coming in at about $318 million. You see the share price reaction there here, 10% to the upside. So at least the knee-jerk reaction investors seem to like.
All right,
what
guys.
they've seen.
GE Vernova, and we should put out Stitch Fix, as you said, up 15% here. GE Vernova also out. Let's get right to the outlook, because that's what investors are going to probably mostly care about. They still see fiscal year adjusted FCF about $1.3 billion to $1.7 billion. The estimate, that's quite a range. Estimate is $1.67 billion. Sees 2025 adjusted FCF $2 to $2.5 billion. The estimate is $1.79 billion. And the company declaring its first quarterly dividend of 25 cents a share. Sees 2025 revenue 36 to 37 billion. The estimate is 37.24 billion. Stock just a hair higher in the aftermarket.
All right.
Can I just say it? They approve a $6 billion share buyback. Just want to squeeze that in.
Okay. Well, that might account for why the stock is up a third of 1%.
Right.
I'm looking at GameStop, and as usual, there's not a whole lot to work with here, but we can tell you that third quarter adjusted EPS came in at 4 cents a share. Net sales did seem to miss analyst estimates as well. And in terms of hardware and accessory sales, that fell 28%. There aren't really estimates to compare it to. There are 2 estimates, really, and that did miss analyst estimates. The stock up about 2/3 of 1%, but when has the stock really ever moved on earnings?
Yeah, no, that's a great point. I'm taking a look at General Motors here. Some announcement coming out here as well. GM halting funding of Cruise's robo-taxi development. GM's going to combine Cruise and GM technical teams into a single effort to prioritize the development of advanced driver assistance systems on a path to fully autonomous personal vehicles. So they're kind of realigning what they're doing on that. They're going to build on the progress, they say, of Super Cruise, which is the hands-off, eyes-on driving feature that's now offered and currently logging over 10 million miles per month.
Yeah, obviously a bit of a cost savings, too, saying that it could lower spending by about $1 billion a year. But this is kind of a long time coming. We talk about the big changes that we saw in the executive leadership for that Cruise division. And then some of the comments by Mary Barra herself here is not that they're abandoning this project, but it was clearly very costly, and at least in the short term, hadn't really been providing anything accretive to the bottom line. So I guess she's doing what she has to do to keep this thing alive.
Also, if I remember correctly, the challenge is that the actual company's cars have had in the real world, navigating the real world environment, and the way that we're seeing Waymo just continue to announce expansion, it's trying to do the exact same thing.
I've always been curious about the technology, because obviously they're using slightly different technology, but the underlying nature of it all is still the same. So I'm always confused as to why one of these companies is able to make progress and the other isn't.
And not to mention completely different tech than what Tesla is doing.
Tesla has,
with its cameras.
One last headline: GM impact to raise Cruise stake to over 97% from about 90%, so upping it by about 7%. All right, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, folks. We call it the closing bell. We will see you again, same time, same place tomorrow.
A lot more coverage coming up here on the big program. Stick with us. And I leave you with the question before we go to break. We're going to take have a discussion up ahead here with Dan Hunt, of course, owns the Kansas City Chiefs, as well as the FC Dallas soccer team. That conversation coming up in just a second, right here on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. An interesting day here in U.S. markets, as I think a lot of people are still waiting for tomorrow morning when we get the latest CPI report, the last one of the year and the last one before the last Fed meeting of the year. A 0.3% pullback on the S&P 500, indicative of what we saw pretty much across all of the major indices here. We'll see if we get a breakthrough tomorrow once we get that CPI report. Yield still pinned right around that 4.14 level on your 2-year, 4.2 on the 10-year. and coffee, Scarlett. We didn't get a chance to talk about it earlier. I talked with Alex. She's weeping, looking at record highs, highest prices since at least 1972.
At least the gains are minimal today,
Yeah.
right? Only up 1.25%. All right, let's talk about a couple of the big movers on the day. Walgreens, Boots Alliance, WBA up about 18%. The struggling drugstore chain surging, and it was actually halted from trading for a little bit on reports that it is in talks to be acquired by the PE firm Sycamore Partners. According to the Wall Street Journal, this deal could be completed by early next year. We're looking at Oracle as one of the big decliners in the S&P 500. The latest results failed to inspire investors who had pushed the software company up about 80%. So far this year before these results crossed. So anything short of perfect really kind of just disappointed. And Servomed was the biggest decliner in the Russell 2000, a small cap name. This is the drug developer that said a mid-stage trial of its dementia drug failed to meet its objective. So that stock down about 79% on the day. Our top story this hour is about hedge funds and how they're setting their sights on a new target, mini millionaires and the 401k crowd. And the reason is because their traditional clientele of big institutions and the ultra wealthy have turned cautious after a few years of hedge funds trailing the S&P 500. But it is buyer beware because giving individuals access to some of the most well-known hedge fund firms doesn't change the fact that there can be higher fees and the added risks of leverage as well as liquidity. Romain?
And that is our top story. It is one of the most read stories on the Bloomberg terminal. And joining us right now is the reporter behind it. Hema Parmar joins us right now here in Studio 2, who covers hedge funds. And I feel like this has been a trend that's kind of been unfolding all year long, maybe even prior to that. What's really driving it?
Yes, so it's been a trend that's been really gaining velocity in recent years. As you see hedge funds really pushing in to these high net worth individuals, these bank wealth platforms, raising from them and seeking to raise from them with a lot more fervor than they did before.
So which firms in particular are doing this, reaching out to individual investors?
Yeah, so we're seeing some hedge funds that traditionally didn't really embrace this group. Elliott, for example, is a firm that's known for being quite picky with who they let in as investors, and now they're actively going out there to raise from bank wealth platforms. We're seeing Viking, Coatue, Balyasny, some of the biggest firms in the industry really embracing this group of investors.
This was almost verboten a few years ago, right? I mean, there was always this idea, at least in the heads of regulators, that somehow less sophisticated investors, if you will, had no business being in these types of vehicles, that there was a level of risk that they just couldn't comprehend and shouldn't do it. I mean, what's changed? Because the regulatory environment hasn't changed, has it?
No, not so much. And hedge funds have been investing in this group for some years, but really not to the extent that we're seeing right now. And there are pros and cons, right? So this shift is a democratization in some ways, allowing everyone access to some of the best performing hedge funds in the industry. But it comes with some cons. So you're looking at fees, an additional layer of fees. Taxes can be quite onerous. And then to your point on sophistication, these groups of individuals may not know as much and be able to siphon through the most sophisticated, less risky fund and the one that might be a bit more tricky.
So there's got to be some education effort on the part of the fund managers. What efforts specifically are they taking to tap this crowd?
So we're seeing some hedge funds offer webinars to this group of people to help educate them. We're seeing hedge funds offer tax-friendly versions of their funds. Some funds are bringing their minimums down, lower, and some funds are going out. They're going to RIAs across the cities, big cities that you may not think of traditionally, Cincinnati, Phoenix, to go and meet with RIAs and to take these meetings and to try to raise money.
All right. Hema Parmar, thank you so much. Hema, of course, covers hedge funds for us here at Bloomberg News. Our next guest is weighing in on the biggest trends in the hedge fund space, and following what we just learned from Hema is saying, quote, hedge funds are in bidding wars for marketing talent who specialize in reaching private wealth clients. Let's bring in now Alexis DuFresne. She is founder and CEO at Archer Search Partners. It's an executive search firm. And Alexis, you heard what Hema was saying about how the hedge funds are democratizing access to their funds and reaching out to mere millionaires as opposed to ultra high net worth individuals. What does that mean in terms of the kinds of people they need to hire to educate this new pool of investors?
So it is about the education in general that differentiates, I believe, but there is a lot of crossover in the institutional world as well. This is just a more nuanced space when you're marketing to high net worth investors in mass versus institutions, which you're probably going to be more tailored towards and probably have an investment philosophy and an understanding of the product. On the high net worth side, we're just seeing the democratization over doctors, lawyers, sort of like lower minimum clientele with RIAs and wealth management advisors as the intermediaries. So it could be the gift that keeps on giving. If you partner as a fund, as a channel manager for one of your RIA partnerships, you could have clients that just continue to put in more money into the RIA as the intermediary for your fund. So you basically put a group together that's very high touch and working with these platforms, and making sure that their clients know what they're investing in, and they help with the branding too. And that's where hedge funds did not do a lot of, that's what they did not do a lot of in the past.
Where are we in this process? Are we talking about like the first inning, second inning, or is this kind of already the fourth or fifth inning?
It depends who you ask. I think if you're asking the independent asset manager, they are probably in the earlier innings of this, because it is capital intensive to put together a group that can service this network, because it is serviced differently than institutional. And I feel like, you know, as the year goes on, we're only going to see this space accelerate.
Well, Alexis, I want to talk about that structure, because that seems to be one of the changes that I don't think we're talking enough about. I mean, the way these hedge funds marketed themselves and sold themselves, you can't do it the same if you're talking about going through these wealth channels for lower high net worth individuals. I was going to call them lower income, but lower high net worth individuals. It's a totally different animal, and you have to explain things different. You probably have to explain things multiple times in a way that you might not have had to do. And you have to do a lot more pitches. It's not just going into one big conference room with a bunch of folks making your pitch and walking out with the deal. So do they have the staffing to do that right now?
We do. 60% over last year is the number that I'm giving in terms of mandates that we've been requested to fill for this specific role within distribution.
Well, repeat that number again.
60% over last year, over about 15 months, 15-month time frame, because we're in the midst of hiring cycle now. What I can tell you is that these groups are continuing to get more specialized. Like any other marketing group channel has in the past, whether it be pensions, foundations, endowments, and now we have these private wealth channels.
Where are these hirings coming from? Are they just being poached from other banks, other financial companies? Or are they coming from outside the financial industry? Where?
They're all coming from asset management. People want people who have sold into this channel before.
Gotcha. Okay.
So we want to look for people who are already sitting in this role at a forward-thinking hedge fund, or who are perhaps working at a larger platform and want to go make a difference at an independent manager, manage a channel.
You know, as we talk about hedge funds democratizing access to their products, I'm thinking a lot of them are turning their funds into ETFs as well.
That's correct.
That creates a whole nother structure of teams that they need to hire, whether they outsource it completely or whether they do it inside as well. What are you seeing on that front?
I'm seeing in the independent managers, it's mostly, let me get a team of professionals together who are either product experts or who either are marketing segment experts. And that's where we're seeing the crossover of people who are talking to the right people, but may not be marketing the exact product at the moment, like, as you said, ETFs or potentially other long-only oriented products.
So just give us a kind of an idea, when you look a little more long-term, say beyond 2025, are we still going to see this type of expansion? Not necessarily at the same pace, but is this an industry that is just going through kind of like one big sort of growth spurt, if you will, and then it's all over? Or is this kind of the start of a much more structural change in the industry?
Oh, Romaine, I think this is part of a structural change. I think we now have technology that can back this market silo as well. And things are moving incredibly fast in trying to capture wealth from these channels. It is a big investment that funds are making in their people.
All right, Alexis, got to leave it there. Great stuff, and a great story that actually features Alexis. Alexis DuFresne is the founder and CEO at Archer Search Partners. We do have some breaking news. Earnings out of Dave & Buster's. Play as your ticker, and those shares, they are down. Third quarter revenue, a miss. $453 million. Street looking for $463. Their third quarter loss, a miss. 84 cents a share loss. The Street was looking for a loss of just 42 cents a share. No guidance that I'm seeing that jumps out at me, but overall, comp sales in the quarter, Scarlett, down 7.7%, worse than the average of Street estimates of 6.3.
And worth mentioning as well, the CEO, Chris Morris, is resigning as well from Dave & Buster's. We'll try to get more details on that for you as the headlines cross. Now, coming up, we've got the top three, speaking of folks who are making news, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Lula da Silva, Brazil's president. He is awake and conscious after undergoing an emergency brain surgery in Sao Paulo. Apparently, he was feeling headaches on Monday, and a brain scan showed internal bleeding. And this all goes back to an accident that he suffered back in October.
Yeah, I mean, obviously, we're talking about a man in his 80s, and it gave a lot of people a scare, I think, when we first heard about it. But at least the latest news appears that he is stable, and they're saying that he will be back to work in short order.
Yeah, he had to cancel his trip to the BRICS summit in Russia. He also didn't make it to Peru for the APEC summit, but he managed to host G20 in Rio. So.
Absolutely, yeah. I'm keeping an eye on a guy named Michael Del Pozo. He was a Hershey's executive. In fact, was the president of U.S. Confections. And guess what? He's stepping down after just 3 months to go back to PepsiCo. And, well, there might be a reason for that. Of course, all the talk right now about what Hershey's future could look like under a potential Mondelez. Of course, we should point out that's based on Bloomberg reporting, citing people familiar with the situation. Yeah, no confirmation from either company that this is a deal that's going to happen, but obviously a lot of speculation.
And the speculation is there because Mondelez has made overtures in the past, which didn't go forward because Hershey's rejected it. So we'll see how this all plays out this time around.
And I just want to point out, too, before we move on, too, Michelle Buck coming back, which I thought was also a bigger deal, just seeing her name pop back up, coming back into the fold to take his job, Michael, as he moves on.
Yeah, well, until they find a replacement.
Yeah, temporary, interim.
Okay, let's move on to the third person on the docket, and that is Mariah Carey. You know that we are in countdown mode to the holidays when All I Want for Christmas Is You is playing wherever you go, any mall, any outdoor shopping center, it's always on. The song has taken the top spot once again on the Billboard Hot 100.
So can I just say, this might have been the biggest flex in the history of flexes by Mariah Carey. When she released this song, it was kind of a throwaway. I mean, I was looking at the history of it. It didn't really just take off immediately. It was kind of like that slow burn. And now it's basically become probably one of the greatest modern Christmas songs, right? I mean, what even comes close to it?
I know, nothing.
You have to go back to, the old days when, Burl Ives or something was singing, White Christmas or whatever song he sung. And it's just phenomenal. And then she's made a whole career out of this now. Yeah. She's got the big shows that she does, which used to be a Radio City. Now she's doing in big stadiums. Did you see the whole intro video? She does these videos to announce the start of Christmas every year. And it's always elaborate. And this one, my wife was showing it to me. It starts off, it's dark and kind of Halloween-ish. And then all of a sudden, it's
this
boom,
is her moment.
Red and white all over, and then she breaks out into that high note and lets you know that only she can hit those notes.
I actually went to her Christmas concert, I think 2 years ago at MSG.
Was it fun?
It was something, it was a spectacle.
I have not been to one, but I would like to go one.
She had someone come on stage to powder her nose.
As she should, because she is the #1 diva in the world. Congratulations to Mariah Carey, who basically sits atop the charts every Christmas season now and for eternity. When we come back, we're talking the business of sports. Dan Hunt, the owner of the Kansas City Chiefs, as well as the president and GM of the newest WNBA team, a separate person is going to be joining us, of the Golden State Valkyries. All sports, all the time, right here on Bloomberg. All right, give it up for the Kansas City Chiefs, clinching a 9th straight AFC West title, the second longest streak in NFL history. The defending champs looking to further etch their names in the record books on a quest for a 3rd straight Super Bowl title. Joining us now is Kansas City Chiefs owner Dan Hunt. He's also the president of FC Dallas Soccer. Pleased to say he joins us here in New York City. Great to see you, Dan.
Great to see you guys, too.
Let's start off with the Chiefs. Everyone's favorite topic, unless you're, not a football fan, then it's, Travis Kelce and Taylor Swift. This has been a juggernaut. Obviously, you get these sort of periods in NFL history where people start talking dynasty. I don't want to jinx it here, but you guys have been on a great run. That's going to continue?
It's been a dynasty. It's been remarkable. To have the chance to make NFL history and win 3 Super Bowls in a row is an amazing accomplishment. establishment, and we have such great leadership. My brother Clark has done a great job, and Mark Donovan, president, Andy Reid, head coach, Brett Veach, general manager. It's a dream team.
Well, despite your ownership of the Kansas City Chiefs, your real day job is probably more aligned with the FC Dallas MLS soccer team, which is also coming off a pretty phenomenal season. I heard you sold out every game for the first time in the team's history?
Yeah, we sold out all 17 home games, which was an amazing testament to where the business has gone. And our father had always said that he had put us in the right spot in the city, and we're in Frisco, Texas, which really is Sports City, USA. The business dynamic that exists there is amazing, and we're getting ready to do a $182 million facelift to our stadium.
Yeah, that was announced in September, and it'll be a public-private partnership as well. Taxpayers, we know, have become a lot more discerning about which projects they'd be willing to publicly funded. So I'm curious, from where you sit, what is the single most important argument that a team can make to its community about the benefits, the financial benefits, the community benefits for financially supporting something like this?
Yeah, we bring almost 2 million visitors a year to Toyota Stadium and Soccer Center. So we support a number of the local businesses around. And the way the bond mechanism works, the city participates, but the school district also benefits. So they will get a massive return on their investment in the stadium. The school district plays games there. We host a number of college football games, including a bowl game coming up, and then the FCS National Championship game. So we bring all these great events, and by renovating the stadium and making it state of the art, we can continue to chase concerts, continue to try to add football games like Scooters that we have, the bowl game, and bring other premium events to the community. And the individual economics of it are amazing. We did a study, and it showed the economic impact at one point $140 million a year on the community.
That's pretty remarkable. You mentioned that this is a stadium that will host college football games and other events as well. This is actually a soccer-specific stadium, the third soccer-specific stadium in the U.S. Can you explain to me what advantages or drawbacks that brings in terms of when you're trying to convert it to a stadium to host other kinds of events?
You know, my father, Lamar, was a dreamer. He believed so much in soccer, but he knew the only way it was going to succeed was to have soccer-specific stadiums. And by doing that and taking the first plunge in Columbus and building our first stadium there, and then LA was the second, and Frisco, our Toyota Stadium, was the third, it kicked off this gigantic movement. And so we're building these stadiums. They continue to get nicer and more amenities. When we're done with the renovation, we're going to have 57 suites, 6,000 club seats, largest video boards in the league. And they're the right size to host a lot of other events, concerts. Look, the premium revenue is what really drives a lot of sports teams, football, soccer, basketball, and the concert business. And we're really, taking a major leap into that and being able to host these great events. And then obviously World Cup 2026 is coming up too, and we hope to be a home base camp for a visiting national team.
I am curious, though, when we talk about using it for these other purposes, particularly for concerts and other venues, does being in an area like Frisco, does that work against you? I'm talking like with regards to concerts rather than the sports events.
Yeah, look, we live in a competitive city. I mean, the Metroplex is gigantic. So many great venues. Obviously, you have AT&T Stadium, there American Airlines Center. So we're always competing for concerts, different events. But by modernizing our stadium and getting it back to that state of the art, it allows us to compete. We're not going to get them all, but if we can get a share of them, then we're going to have a great return on it. It's going to continue to help us grow our business there. And obviously, it's an incredible experience for our fans.
Of course, the World Cup is maybe a year and a half away or so, give or take, here. And obviously, Dallas and your stadium is going to be a big component of that.
Yeah, it's been 7 years of my life working on World Cup. It's really hard to believe, starting back in 2017. And I am so excited for the World Cup to come in 2026. Obviously, 1994 was amazing. Dallas had a number of games. I had the International Broadcast Center. I didn't appreciate it at that time, but my father was so proud of the International Broadcast Center being in Dallas and what that meant for our city. And hopefully we have a chance to get it for World Cup 2026. But having 9 games, a number of them, they'll be at AT&T Stadium, and we have a World Cup semifinal. The number of elimination games that we have, there will be more drama that takes place in Dallas for the World Cup than any other city.
They hosted an America Copa game in Miami, and it didn't go so well with the crowds, and the game was delayed. What are the lessons learned from an incident like that the stadiums that will be hosting World Cup games should take away?
Yeah, the great news is MLS will be very involved in this, and obviously it was an unfortunate incident around such a special game that took place. But yeah, fan safety is a big one, right? Our first thoughts have to be with taking care of the fans, taking care of the people that work there, the players. And so there were some lessons taken. I think, you got to be incredibly thoughtful in ticket distribution, security barriers. FIFA thinks about things, very differently. They're generally gigantic perimeters around the stadiums. It's not like your typical NFL game. And so I think there'll be a very thoughtful security process. Transit is obviously a big one, and each market is unique. In Texas, we live in a driving and tailgating culture, which was really exciting to talk to FIFA about that opportunity that exists with tailgating and everything that goes on around the stadium and all the additional programming that we can do. So there were lessons learned. It was unfortunate, but I think we'll all be better for it going forward in 2026.
Now, speaking of international soccer, the MLS is considering shifting to a European soccer calendar. I believe this is going to be a big point of discussion at the MLS owners meeting. How are you thinking about this?
Yeah, look, in my opinion, I think it potentially is a great thing for the league. There's a reason why Europe is in the calendar that it is. A lot has to do with weather and climate, right? And we have such a diverse climate here. But I think for us, a big part of the soccer business is the player transfer business, where you're buying and selling players. And obviously the top markets are in Europe if you're going to transfer a player there. So I think we'll be able to participate in much higher transfer revenues if this happens, if the membership approves it. And that's money that can be completely reinvested back in the MLS product, reinvested in players, facilities, academies, and I think it will really help grow the league. And also, you're not necessarily competing against college football and the NFL late in the year. And I know you'll be competing against, hockey and baseball and basketball, but I think it will be, great to, have a more traditional calendar, and, we'll see how the membership feels about it.
Do you think we're going to see more of those sort of big international football/soccer stars actually come to the MLS, not when they're basically a step away from retirement, but maybe when they're still in their prime?
Yeah, I mean, if you look at our payrolls, they continue to grow at such a high rate. And we have the mechanism, the DP mechanism, to bring 3 per team. And the league continues to add mechanisms and work with the union on this. Obviously, Messi was gigantic news. It was transformative. But the number of top players that have an interest to come to the United States and ply their trade at some point in their career is great. But you hit on it. The key is not at the end of the career. We want them in their prime. This is a gigantic, sports-consuming audience in this country, and to have top athletes at the top of their game will do wonders for Major League Soccer.
Who's the player that you want to see come over to MLS? Come on.
I mean, Kylian Mbappe might be at the very top of my list. What a tremendous player! But there are so many. I mean, Neymar, obviously, Ronaldo. You have names like that. I want just the players that are going to, put forth, the best effort, be invested in the league. That's been one of the most refreshing things about having Lionel Messi, is his desire to grow Major League Soccer. And it's really a partnership there. So I think there's so many top talents that will grow MLS.
Dan, it's been a pleasure. Thank you so much for coming by. Dan Hunt is an owner of the Kansas City Chiefs, and he is a president of FC Dallas Soccer. Let's turn now from the gridiron to the basketball court, where the WNBA's newest expansion team is one step closer to solidifying its team. The Golden State Valkyries, which kicks off its first season this spring, has selected players from all but one WNBA team just recently on Friday. And more moves are expected to come. The Valkyries have the 5th pick in the WNBA draft in the spring, and they could make some off-season changes through trades with other teams as well. We're pleased to say here in studio now to tell us more about the team's path forward are Golden State Valkyries President Jess Smith and General Manager Ohemaa Nyanin. Thank you both so much for coming in today.
Thank you for having us.
Jess, let me just start with you as the president of the team. It's all starting to come together. What do deposits for season tickets look like right now? I know it's still early, but I'm wondering what kind of overlap there is with your affiliate, the Golden State Warriors.
Yeah, we have close to 21,000 seat deposits placed at this point, and we've actually just finished our seating for our premium deposit holders and only have a few seats left there. So we are actually starting our general deposit phase and just seeing tremendous support. I mean, the Bay has showed out from us from day one. Even before we were the Golden State Valkyries, thousands of people said, hey, we're interested, whatever you build I want to be a part of that. So we're listening closely to that fan base, but so impressed that they're showing up in this manner.
All right, this is what the building of a community looks like. Ohemaa, you have finally entered actual team building mode as well. You've chosen 11 players in last week's expansion draft. Next up is signing free agents. Talk about the challenges of building out a team when there's going to be a new collective bargaining agreement after 2025. I mean, it feels like you have to plan for 2025 and also at the same time plan for 2026 and beyond.
Yeah, I think we were given a blank canvas. So how we build is kind of like incremental. We're looking at 2025, we're looking at 2026, 27 and beyond. Mr. Joe, our owner, gave me this really good challenge, which is to win a championship in the first 5 years. And so here we go.
That's a big challenge. I'm sure you're up for it. And it gets to this idea, though, of what do you need to do next to get that? I mean, we're just showing the roster from the December 6th draft here. Obviously, there'll be changes over the next few years as you see fit here. But what builds a championship team in today's WNBA? And I'd be remiss in asking that question and not asking about Caitlin Clark and her impact on what we saw last year.
Yeah, I think relentless competitiveness, first and foremost. For us, connectedness is something that we talk about a lot, and selflessness. So we're looking for athletes who are not only elite on the court, but elite off the court, and are going to be able to help us build the community and the fan base to support us winning our first championship.
Well, speaking of that fan base, Jess, I am curious about the fan experience at these stadiums. I've never been out west to any of the games, but here in New York, if you go to the Barclays Center to see the New York Liberty, it's an experience, and it's an experience that's actually a lot different than what you see with the Knicks, the men's team here. And that's been very deliberate, I know, on the part of the ownership there. Are we going to see something similar out of Golden State?
Absolutely. I mean, you can see from the brand that we built, right? So same ownership group, same venue that we're playing in Chase Center. And of those 21,000 deposit holders, less than 5% actually cross over to season ticket holders of the Warriors. And that's the point, is that you have two completely different audiences showing up for these different products. Will there be casual fandom between the two? Absolutely. But we are building something uniquely for this group of folks.
I am curious on that. Are the fans in the WNBA kind of more basketball fans as opposed to the NBA, where you get more casual fans in the stands, or is that just kind of a mix?
It's a mix. Yeah. It's an audience that's showing up. Really what you're seeing in the WNBA right now is a flooding of diverse audience, young audience coming in. Certainly you mentioned Caitlin Clark. The rookie class in general this year really brought a big audience with them, and that's only going to continue with the tremendous talent that we're seeing come in. And so that audience is hungry for more. They're engaging, and this is the top league that they're following. So that's an incredible opportunity both for us, but in the league in total, of just how we are nurturing and catering that fan when this is what they care most about, and they're casual fans of other sports, where traditionally what you've seen is most people assume there's that like high fandom for men's sports teams, and then maybe they're following women's teams. That's not the case.
Caitlin Clark really set the W on fire and introduced it to the casual fan. With the WNBA draft coming up in the spring, you have the 5th pick, Ohemaa. From where you sit, how do you see the league building on the excitement that Caitlin Clark generated, just from her being part of that draft, and of course, her prominence in becoming Times Athlete of the Year? What's the way to build on that and to continue it?
Yeah, I think first and foremost, the NCAA March Madness tournament last year, I believe, had more viewership than the men. And so I think that's what's going to help propel us into having and selecting, elite level athletes from the collegiate space. I think the international nature of the game as well. We have 7 out of our 11 inaugural athletes are not from the United States. And so just the globalization of the sport as well, I think, is going to help propel the league and each individual team to grow.
Yeah, and not so long ago, you were part of the New York Liberty as well. You were assistant GM, which of course just won the championship. I'm curious what elements of that experience, what you have learned in Brooklyn, do you think you will be able to bring over, and what will translate to the Golden State Valkyries?
Yeah, relationships. People matter. I think, when you have a goal, sometimes you don't think about the people that are, working alongside of you, and servant leadership. I think that's something that I honed while I was here.
Servant leadership.
Yep.
What does that mean?
It just means, being selfless. It means no task is too big or too small. And it means you come to work with joy.
Jess, I want to talk about pay for the athletes, and not just their salaries, but also the opportunities they have to make money through endorsement deals and other sort of business ventures that we know the men have enjoyed for quite some time. And maybe things change now that the WNBA has sort of rose in prominence. But I am curious about what types of opportunities you're going to see for some of your players over the next few years to really increase their pay so it's more commensurate with what some of the men would make, professional men.
These athletes are cultural icons, right? A variety of them are setting the tone, and everyone wants to know everything about them, what they're wearing, who they're talking to, what they do on game day, what they do in their off season, and so forth. And the world is taking note, and the opportunity continues to rise because of that for them individually, right? So these endorsement deals are because of who they are as people on and off the court, but they're also because the global market right now, and certainly the brand strategies, are taking note of that too. They are reaching that consumer that we talked about. It's actually really difficult to reach elsewhere. And so the opportunity for them to do that while being their full selves is immense. And I think you're seeing the multi-dimensional woman represented through these athletes, which is a tremendous opportunity for many brands that are seeing the opportunity there.
And I would think, Ohemaa, given the market that you're in, I mean, San Francisco, obviously a big media market, California overall, obviously a huge media market. I would think the opportunities there might even be riper than, say, for some of your peers on other teams in lesser media markets.
Yeah, I would say so. It's a conversation I have with Jess ad nauseum. Being an East Coast girly, learning the Bay while I'm building a team has been an interesting.
Have you learned all the Bay lingo? Because I'm still trying to catch up. Yeah.
Okay, well, we can learn together.
Okay, all right. We'll just put on some E40 albums.
Yes, exactly.
There we go. That's all we need.
Absolutely.
They use the word hella a lot. I got to ask you guys about a mascot too, whether there's any progress or development on that. Do you plan to have one? And if you do, how do you make sure it's imbued with its own personality, like Ellie the elephant?
Yeah, intentionality, as we've talked about, is across everything that we do. So our brand, how it came to life, if and when we were to explore a mascot, we're going to do a lot of listening to our community first, right? It has to be ours. It has to be the Bay. It has to be something totally, right? We're not doing something because someone else did something or because we think we should. Every element of what we do needs to be genuine to our fan base and something that they want from us.
So I'm going to give you the final question, Ohemaa, because when we talk about when you actually start playing and you kind of have to manage this all here, is there a sense here that coming in for that first year, with all the pressure that your owners put on you to get a championship within 5 years, you're not going to have your players feel that pressure, are you? Are you going to try to?
Absolutely not. Yeah. No, that's exactly what you said. The weight is on my shoulders and my shoulders alone, and I. Hold it alongside Jess in terms of
this is a support group.
Yes. And what I will say though is our athletes can't be afraid of the pressure, and they need to have the hunger to always want to put their best foot forward.
All right, this was a great conversation and great to meet both of you here in person. Ohemaa Nyanin, President and General Manager of the newest WNBA team, the Golden State Valkyries, and also our thanks there to Jess Smith as well. Thank you both. Appreciate it.
Thank you. Appreciate it.
All right.
All right, let's get back to what happened in trading today. Just a quick recap here, because after days and days of making steady record highs post-Thanksgiving, the S&P 500 and the Nasdaq 100 have kind of stalled out this week. You could see the S&P losing about 0.3%. All of this before the big CPI print tomorrow. Although the Mag 7, notable here, did finish higher.
Yeah, there's been kind of this flight. I don't know if you call it a flight to safety, but certainly a flight back to some of those large cash-generating companies, and that's at the expense, of course, that rotation that we had seen into small caps and cyclicals.
Yeah, and worth noting as well, the dollar is at the highest versus the Canadian dollar since April of 2020. The Bank of Canada seen cutting rates by 50 basis points tomorrow.
All right, we'll be back. A lot more coming up here on The Close on Bloomberg. All right, well, roughly the 2-week delay in getting earnings results out of Macy's, that comes to a head tomorrow on December 11th. They are scheduled to report their earnings before the bell. This after yet another activist investor has popped up, urging the retailer to form a separate real estate unit to help sort of further his company's aims. Mary Ross Gilbert joining us right now of Bloomberg Intelligence. And Mary, let's start off first here before we get to the activist investors with the quarter that was a delayed quarterly report, of course, that was upended by the revelation that at least one employee had somehow, taken advantage of a certain cost structure there that led to what I'm going to assume is a restatement of earnings results. What are we expecting tomorrow?
Yeah, so I think hopefully we'll find out more about that. It was related to a 3-year period, and it's up to 152 million. They kind of gave a range, but covering it over a 3-year period. It doesn't really affect cash. We're not too concerned from that perspective, from a cash flow perspective, but just from a financial controls perspective. I think the real focus tomorrow is going to be on the earnings, how things look in the holiday quarter, which based on the data that we're tracking, they had a good Black Friday through Cyber Monday, but in terms of where they're tracking very close to consensus estimates.
Yeah.
Excuse me.
Yeah, and I was taking a look here at some of the estimates, Scarlett. We talk about the idea of adjusted EPS at 3 cents, but we talk about the growth story.
Yeah.
And the question also I have, too, is this was an earnings report that was supposed to come prior to the Black Friday shopping season. It's now coming after that. I wonder how much of an update they're going to give us as to how things fared in, I guess, those a couple of weeks that would not have necessarily been reflected in the earnings report.
No, that's a really good point. And perhaps that gives a window into how other retailers have performed as well. Mary, there's a lot of talk from the activist investors about spinning off Bloomingdale's and Bluemercury because that would unlock more value. I mean, those are the best performing parts of the Macy's empire. What are you looking for in terms of what Macy's says about those brands versus Macy's proper?
Yeah, Scarlett. So with regard to Bloomingdale's and Bluemercury, they're the luxury units, as you pointed out. Those are the better performing ones. Rather than selling them, because they're basically saying, look, we should see how we can extract value here. So it's sort of like selling them off. I think what they should do is spin off a minority stake so they still own a majority stake in the company. They create a tracking stock, if you will, and this way it can command the value that it deserves, so that it's kind of like taking the parts of Macy's that are undervalued, like the real estate, except, and we'll talk about the real estate in a minute, is that could be a better way. We do not think forming a propco and turning around and charging market rent to Macy's retail operations is the answer, and it has failed time and again. Because first of all, they have about $2 billion of EBITDA. Yeah. The rent would be about $1 billion.
Yeah,
and then if you look at our Oh, sorry. Go ahead, Scarlett.
No. That's pretty sizable. And of course, the activist investors have estimated that the real estate is worth up to $9 billion. So that is something that they're eager to kind of leverage. Mary, I think we got to leave it there, but I really appreciate your joining us today to give us a glimpse into what we might expect from Macy's tomorrow. That's Mary Ross Gilbert of Bloomberg Intelligence. She covers retail for us.
All right. Macy's earnings coming out in the morning. Other potential market moving events include NBA mortgage applications out at 7 a.m. and at 8:30 a.m. Washington time, that monthly inflation report.
Yeah, this is the big one, right? A lot of people are expecting another stubbornly high core inflation print. The slowdown in shelter offset by pickup in other core goods and services. 0.3
on a month-to-month basis, ex food and energy. 0.3, pretty much in line with where we were the previous month. 9:45 a.m. Bank of Canada has a big rate decision, and we get earnings after the bell tomorrow from a big tech company.
Yeah, Adobe is going to be reporting, and of course, a lot of eyes on what it says about its Gen AI businesses.
All right, and keep an eye on China as well. A lot of people wanting to hear what potential economic stimulus measures may come out of those leaders who are scheduled to hold their annual Central Economic Work Conference. That does it for us here on The Close. Stick around for all your politics coverage. Balance of Power starts at the top of the hour on Bloomberg.